Welcome back to Depreciation Lab. In this video, we're gonna do a walkthrough of units of production method or activity-based method. So we are in a business tier account. I have logged in with the business tier account. You will need minimum professional tier account to access activity-based, that is units of production method. So I'm inside the manual entry section because activity-based method and units of production method, which are the same thing. I'm gonna call it now units of production method. Is also part of bulk upload section. As you can see here down, bulk upload, Excel import. We also have a activity based method, that is units of production, and also standard method. So now we are in the manual section. If you are a business tier user, you will have both. So if you want to manage manually one by one up to 50 asset, you can use this section. And if you want to import up to 1000 assets for UOP method, that is units of production, you can use this section. We'll take a look at bulk section entirely different way in the videos in this series in the future. And now let's focus here. So here already have an asset set up. As you can see, it requires a lot of inputs to configure it properly, but we're gonna start afresh with another asset. So let's type an asset ID, then we're gonna call it plants. I'm gonna call it printing press machine or printing press. It was bought on March 1st 2020 with an asset cost of $500,000. As you can see, we don't have a life as an input value. So as you understood, or I hope you have seen my video on units of production introduction, the theory part, the theoretical video where I explain what is units of production method. It is not a time-based method for depreciating your asset. It's a usage based. So unlike standard methods, which is SLN, DB and DDB, units of production method requires units and consumption data. So that's why Depreciation Lab is configured in a way that you won't have an opportunity to even mistakenly add a life for units of production method. So here we'll require a salvage value. So let's put 50,000 as a salvage value and units of production is our method. Here we're gonna put tax rate of 30% and discount at 10%. And let's add all the events. Now in units of production method, we already entered the asset cost and salvage value. Now the most important part or most important thing in units of production is estimated units. So since this is a printing press, we're gonna assume it's gonna give us 10 million units. Let's say 1 million unit. So 1 million units of impressions, and you can type impressions. And now we're gonna add the log, production log. So this is also very important input. So we're gonna start with after any date after the purchase date basically. So suppose we bought this machine on 1st March, we start with 1st April. And this would require a start date and end date. So it could be any period basically. It could be crossing your financial year, or it could be over even months, or it could be 1.5 years. It's up to you. But usually you should contain within a year so it fits in your accounting period and your financial reporting. So anything up to a year, it's fine. It could be 3 months, quarter, or month even. But up to 1 year is good, because it keeps your accounting and reporting also clean, and you don't have to guess or double check on the depreciation amount. So here we're going to start with the 9-month depreciation, that is April till December. So I'm going to add 31st December 2020, and out of 1 million we're gonna produce 80,000 units or impressions here, and then add another period. And here we'll start with the 1st January 2021, 31st December 2021, and let's keep 100,000. And you can see here the capacity meter, or you can say the bar, is keep increasing. So let's add some more units like 250,000. And in the 3rd year, we're gonna start with January 2022 to December 2022, and here we're gonna produce 350,000 units. Now you can always see remaining units. Your capacity was 1 million. Now you already produce this much of unit, that is 80,000, 250,000 and 350,000. So that total used unit or consumed out of 1 million is 68. That would mean that you have 320 units left from the total capacity this particular printing press machine has it. Now let's add one more period, and here we're going to add remaining units. Now suppose you have a capital improvement. Now here, before capital improvement, if you can see all remaining units are 0, that means over this 4 years, and this was a partial year, but over these 4 years, this machine capacity has been exhausted completely. But suppose we need this machine to keep running and serve us for at least a few more units more, like not few more, at least 50% of its capacity more. So we're going to add some improvement. So we're going to put a scenario. So let's suppose in end of 3rd year, so somewhere in mid 2023, we added additional capex of 175,000, and suppose we got additional 250,000 units, and the new salvage value has now 75,000. So if you see here, when I added this amount, these units also changed. So total capacity now became 1,250,000. That is the addition of 250,000 to original capacity of 1 million. So 1 million plus 250, 1250. So if you want to see again, if I make this 300, I make it 0, it'll go back to 1 million. But as soon as I add, as you can see, the changes gives you a control on your data input, and also is visually appealing to keep track of your inputs and data. Now let's do impairment as well. We're going to make this example exhaustive. So suppose at 2025, in the last quarter, let's suppose in October, we have impairment, and the carrying value now is suppose 250,000, and revised remaining capacity at this stage, suppose it is only, we had 1 million to, suppose it is only 350,000, and suppose we dispose it off somewhere in 2027. So let's take 31st July 2027. And we're going to dispose it off for 150,000, and 5,000 is the sales expense. And finally, unit produces 1 million, right? So this I will explain to you when the result comes out of this particular calculation. Now, since we have added additional capacity, we're going to increase the production schedule. So let's go back to production log. We're going to hide this asset and go back to production log. Here we're going to add production log, and to make this example very unique and one of a kind, like covering all the aspects or edge case scenarios, we're gonna add production schedule till the last day of the asset disposal. So now we had only up to 2023, so we need to add some more data, and so I will fast forward this particular part of the video where I will enter all the details manually. So now I have entered the production schedule close to the disposal date, and it is also crossing path with asset impairment and everything. So we'll see the production schedule, how it turns out, and does it takes care of these edge cases or not. So we're gonna save draft and run calculation, and here is the schedule on the screen, but rather we will download the production schedule. Now one thing I want to emphasize is that this UOP method or units of production method doesn't have a monthly schedule, which is like we have it in the other methods, that is standard methods. Since it's a consumption based or unit based depreciation, there is no meaning of giving a monthly schedule, because this period can be anything. It could be 1 month, it could be 3 months, it could be 9 months. So if you really want to do monthly accounting, you would need to do a manual entry of each production period of 1 month in the same setup, or rather you can take an average assumption of depreciation. For example, here we started in April 2020 and our year end was December 2020, so that means 9 months, and we got depreciation of 36,000. You can divide this 36,000 in 9 months and account for your monthly depreciation, and if you need to do monthly book closure, you can do accordingly and record your depreciation. Now here we're gonna download the schedule. Now we got the schedule. I'm gonna hide this other asset which was already existing and focus only on this particular asset which we have entered. So here you can see we had an improvement and cumulative units increase by 350,000, and the app also takes care of remaining capacity at any given point of time, and also the capacity utilization, and also it calculates rate, which is very essential, and based on the rate and the unit it produces, the depreciation is calculated. Now here, since we had an improvement and then impairment, the rates are calculated accordingly. So here if you go to impairment, now in this impairment case, as you can see, we had an impairment at this particular date, 31st October, and the carrying value became 250K, which was more than the carrying value of the asset. That means it was an impairment. So if this happens, you won't have any impairment loss, as you can see here. It could happen in practically in a scenario that net realizable value of your asset could be more than your book value, that is carrying value. So in this case, there would be no impairment loss. If the impairment loss, which you need to assess before you enter, because in this example we entered on an assumption basis, but you need to check and assess what is your carrying value on the impairment date, right? So if it was less than 166K, then in that case there would be impairment loss. But this also shows how Depreciation Lab handles this kind of scenario, right? So it could be a mistake while I was showing you this feature of units of production, but this could be a scenario where you need to be careful, right? So here we can see we had a very small gain or loss. So we have sold the asset for 145,000 and the carrying value is 143,716. So we had a very small amount of gain, and overall you can see the tax shield also and the present value. So this is how you manage units of production method or units of production assets in Depreciation Lab. It calculates and it takes care of all the edge case scenario and practical scenarios. We learned here that in impairment, if you are not careful and don't assess your actual carrying value the time of impairment, which must be higher than your net realizable value, otherwise there is no point of doing assessment of impairment, right? When you do impairment, it's all about assessing whether your asset is really worth compared to your book value. So if you had a proper impairment value here, could be 100,000, we could have impairment loss and all the calculation would change. Let's do change in the impairment value and see what the outcome comes. So I'll go back to the configuration. I'll hide the first asset, open the second asset, and let's do the impairment to 110,000. Okay, keep everything same. We say draft and run it. Gonna hide the other asset, and let's make all the values a readable format except the units. Okay, so suppose in the impairment here we got a loss now. So this was supposed to happen. So we had a 166,000, as I said before, was the carrying value. Now it has impairment loss because the new net realizable value is 110,000 lower than the carrying value. So that means we need to book impairment loss. The future per unit rate for appreciation has also reduced because of the impairment. And we have now more gain because the overall impairment impacted the carrying value at the end of the asset useful life. And we capped the disposal amount same. That's why we have a more gain, that is 56,257, because our carrying value is only 88K. So this was a comprehensive walkthrough of units of production method inside Depreciation Lab. As you have seen, it takes care of all practical scenario possible. So if you want to use this particular method for your business and for your accounting and to get accurate auditable schedules, subscribe to the Pro plan or a business plan on Depreciation Lab, and you'll have this particular feature or this particular method of depreciation for your business. Thank you so much for watching, and I will see you in the next video.